I've got the pleasure to introduce you to Travis Watts. He's a seasoned real estate investor who transitioned from the hands-on hustle of single-family home investments to the strategic ease of passive multifamily apartment investing. Once an active investor immersed in fix and flips, vacation rentals, and buy and hold properties, Travis found himself yearning for a change in 2015 when the demands of property management began resembling a job more than an investment. Today, he's not only a full-time passive investor in the multifamily apartment realm, but also holds the esteemed position of Director of Investor Education at Ashcroft Capital. At Ashcroft, the mission is clear: reposition multifamily properties through a meticulous process of renovation, rebranding, and operational enhancements. With the supports of an in-house property management powerhouse, Birchstone Residential, Travis, alongside Ashcroft, ensures that investors can relish a hands-off approach while remaining intricately involved in the real estate journey. Through strategic oversight and a commitment to investor education, Travis is redefining what it means to be a savvy, engaged, yet passive real estate investor in today's dynamic market landscape. So without further ado, let me bring Travis and Matt onto the show. Hey, Travis.
Hey, Mark. Hey, Matt.
Hey.
Thrilled to be here. Thanks for having me.
Yeah, absolutely. Thanks so much for coming. We usually just kick it off by having you give the audience a little background about how you got into real estate originally, and then just kind of catch them up to speed on where you're at now.
Sure. Happy to share that. So like most people, got started by reading a few books, that of the Robert Kiyosaki's of the world, and kind of opened my mind to maybe I don't want to be a stock investor. Maybe I want to consider the tax advantages and the passive income side of things. So I got started a little over 15 years ago, and I got started with single family homes, like a lot of us do. So it was buy and holds at first, and then it was fix and flips as the market started to recover. And then it was vacation rentals as I started trying to emphasize passive income and a higher potential yield. But then to your point in that description, I got burned out. I was working a full-time W-2 job. I was working 14-hour days. It was nuts. And I just couldn't scale it after a certain point. You know, you get the property 5, 6, 7, all of a sudden it feels like you got to pick a direction. Am I going to be a professional landlord? Am I going to be a W-2 employee? I can't do both. And so that's where I started getting a little more into mentorship, podcasts, books, reading, education, networking. And I discovered real estate private placements. And so I started putting my money into commercial real estate, into multifamily, into self-storage, into mobile home parks, into note lending funds, into ATM machines. I mean, the list goes on, but it's basically anything that can provide monthly cash flow, potential tax benefits on top of that, and then a participation in any equity upside on the deals. So after that, completely changed my life in 2015 and allowed me to leave the job I was doing that I didn't love, that I was burned out in also. I started giving back to others in regard to my time. I had a really hard time finding mentors that would just be an open book with me for free and didn't have something to sign me up for. And so I want to be that person for others. So I just speak out as a fellow LP, limited partner investor, passive cash flow investor, whatever you want to call me. And just launched a podcast called Passive Investor Tips to help people in very short snippets, 5 to 7 minute episodes of just core concepts, fundamentals, tricks, tips, strategies, you name it. So that's what I've been doing the last 8 years. And, Joe Fairless and Ashcroft Capital is just one group of many I've invested with. And I joined their team so I could get on larger stages and, share the word and get in front of more people and just amplify the networking aspect to what I do.
Yeah, that's amazing. We're going to love having you on the show. Both Matt and I have a similar background where we came from grinding it out similarly, first with singles and small multis, and realizing that we didn't want to be property managers and fix toilets and answer calls.
It's all fun and games on property 1, 2, and 3. And then at some point, I guess for me, at least, it got a lot less exciting.
Yeah. So are you acting as a GP ever, or are you strictly sticking as an LP?
I'm not, and it's a very personal thing, but I had burned myself out so bad. I kind of, didn't really go in the details of that, to where I'm like, I'm just done with active. I don't want to flip. I don't want to wholesale. I don't want to buy and hold. Like I am out as an active partner. So no, I'm not a GP, nor do I desire to become a GP. I'm not a co-GP. I'm not a co-sponsor, so my passion's really helping others in the education space. So I ran investor relations for a while with Ashcroft, and then I made a pivot once we had a full team built out over to doing webinars, podcasts, property tours, in-person workshops, stuff like that.
That's really cool. I think everybody aspires to be on the limited side, right?
It's it's funny. Like if I started all over again, would I be a passive income investor on day one? No, I wouldn't, because I didn't have enough capital. It didn't make sense. You got 10K to work with and you go invest at 8% a year. It's not exciting. It's not life-changing. It takes too long. So I put in, my W-2 was just solely for a paycheck at that period of time, right? So I'm earning a six-figure salary and I'm pocketing as much as I possibly can. I'm being frugal like I never left college. So all that extra money is going into real estate as the market's starting to recover and build up. And then hence the fix and flips and everything else. So I think it was necessary to get to a point where you have enough net worth or assets, whatever you want to call it, to put into passive investments to where it does start to make sense. You think about $1 million and now 8%, that's $80,000 per year, starts to have a little more meaning in people's lives. And so that was kind of my threshold right there.
So Travis, let me ask you this. I mean, I don't mean to like open up some wounds and that sort of thing, but can you tell me a story, kind of like what was like a, seminal in your breaking point to not wanting to be active? And is there a particular thing that happened or a story you could tell us as to like, we're like, I don't want to do this anymore, or maybe it was a collection of different things that led to that breaking point?
Yeah, I think I entered very naively in the active space because, who was I in real estate? I had no real estate background, didn't have a family in real estate, had no mentors. I was just winging it. And frankly, the market was helping me out more than anything, and it was like just one property after the next, you start to get a little self-reflection going. And it's like, wow, I don't know how to, like, all I can really do is paint and clean. I don't have any handyman skills. I don't have any connections. I'm not finding the best deals. So as competitors started to enter the market and the institutions started buying up and all this kind of stuff started to change, I started to realize that I really am a small fish in a huge pond. I'm a nobody. And so I started seeing the writing on the wall with that. And I think, to share a quick story, I was on a flip of mine. Well, it was supposed to be a flip. I went over budget, didn't calculate right, and so I ended up having to rent it out for a year. So I'd basically done a full renovation, put tenants in there, and skipped the background check because the guy had worked at my same company. I didn't know him personally, but I knew he worked there. So I thought, there's a built-in trust level here. You know me, I know you, or yeah. Well, turns out they had terrible credit. They had a history of skipping and bailing on properties. They ruined my property. They brought pets in the property. I just put brand new carpet down. The whole place got trashed so far beyond their damage deposit where I had to almost double flip it. I flipped it, I rented it, and I had to flip it again to sell it. And God, I was lucky to maybe get a break even. And it was somewhere in that time frame after having a couple bad tenant experiences, that one being pretty bad, then I'm like, is this what I want to do? Do I want to dedicate to just trying to get better and better and better at this? Because everything's a pain point. And so the answer was no. And when I discovered an alternative path where I could truly be hands off, I was like, boom, bingo, I'm trying it. I was skeptical, not going to lie, but I tried it and I took action, and seeing is believing, I guess.
Yeah. What was that learning process like as far as, vetting operators, and were there any pain points that you went through as you got into the LP side of things?
Yeah, I think the industry is still trying to create a Yelp of sorts, right? An easy place to go to say, here's all the operators that exist. Here's all the track records. Here's all the, reviews. That doesn't really exist right now. And it certainly didn't in 2015. So what I had to do is network in person with people who were already doing what I wanted to do, and they were doing it successfully. And I just started asking them, who do you invest with and what's your experience been? And that's literally how it started. Some local operators out in Colorado. That's where I lived back then. And then it built into me going to national conferences and getting involved with listening to podcasts like yours that can span across the country and in some cases even international investing. And so my world just started to open up and just kind of hyper diversified for many years because I didn't know what I didn't know. And now I'm kind of reeling that back into my top operators these days.
Mm-hmm. Would you say you found a lot of your operators at that like first conference that you went to?
Not at the first. No, I'd say
No.
I found 60 to 70% over the years through some type of in-person event. It's not always a conference. Sometimes it is a local meetup group or something, but I'm a face-to-face guy. I like to meet people, look them in the eye, listen to what they have to say, listen to their business plan, see if we're really going to click. Because when you get in these illiquid investments, you're partnered up for 5-10 years potentially. You don't know. So last thing you want to do is fork over 100K and then realize you don't jive with these people.
Yeah. And you're pretty well diversified in what you're investing in. Do you have a favorite class? I know you like the multifamily space, but what are some of the other ones that you really enjoy?
The reason for value add multifamily class B apartments is that was the closest parallel to what I was already doing and what I already knew and understood, which was class B value add single family. So it wasn't a big leaping step for me. So I still do the majority there. And the reason is I always like to kind of be where the people are, right? I don't like to be in like the highest tier, most luxury, most newly built, highest rents in the market. But I also don't like to be at the very bottom, where you have very low income renters and, possibly a lot of hurdles along the way with those properties in particular. So it's the catch-all. In recessions, people are leaving the more high-priced product for the more affordable product. You always have people moving up from the bottom to the middle. So the Class B is like a catch-all, and it gives you that little buffer of insulation. If rents, soften up or drop even, like we saw in 08, 09, and who knows if we'll see that in the next year, you at least have a cushion because you're buying a property already 200-300 below market rents, and you're just trying to take those rents to the market by doing renovations and making it a nicer, safer, newer community. So to answer your question, aside from multifamily, I like to diversify because I don't believe there's any one asset class that's just going to be picture perfect for the rest of your life. I think markets change, cycles change, and I like to mess around with a lot of different cash flow stuff. As I mentioned earlier, note lending can provide sometimes a much higher cash flow yield, but then you're capping yourself on the equity upside potential and maybe even tax advantages. I like ATM machines, great cash flow. And, you don't have the depreciation recapture in some cases, and car washes and self-storage. But at the end of the day, multifamily also, to add one more thing there, is so in demand, from the fundamentals of it. I mean, we've got the widest gap right now in history between home ownership and renting. And new development as of right now, like new starts, are not happening. So you look forward 3 to 5 years, where are we going to be at? Well, we're already millions behind in affordable housing and apartments. And the supply that's coming on the market now is going to be a short-term negative for pre-existing properties. And then 3 to 5 years out, we're going to be back in the same boat, undersupplied, need more development, takes 2 to 5 years to develop, all that kind of stuff, probably higher wages, higher inflation, all that good stuff. So anyway, that's my, in a nutshell, that's what I do. And that's what I look for.
Do you jump into any of these build to rents multifamily?
Came really close to doing a fund like that. Didn't pull the trigger, went out to the properties, viewed them, toured them. I actually like the concept a lot. I think it makes a lot of sense for people that, again, home ownership's unaffordable right now. So what's the next best thing? Well, maybe living in a house where you can grill and have a yard and have your pets and your kids playing, but yet you don't actually own the home. And I think there's a lot of advantages to that. I've been a homeowner most of my life, but then also I've chosen to rent from time to time because it just simply made more sense in a very, bought up market. When we were in downtown Denver, it just didn't make sense. It's like pay $1 million for a condo and have an HOA and closing and realtor fees and yada, 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 or just pay like $3,000 a month in rent. Just made a lot more sense, at least for us. So, yeah, I think there's I think that's actually one more thing to add to that. That's a huge change people should think about over the last 10 to 20 years. Renting, the old stereotype of renting was mostly kind of a negative thing. It's like, yeah, I have to rent until I can own, or I'm renting, but I intend to own. Now it's like these communities offer so much. I mean,
Right.
gyms and pools and barbecue areas and dog parks and community centers and workstations and all this stuff. And, no special assessments, no increase in property tax, lower insurance, no landscaping, no snow removal, like a lot of perks. So there's a lot to be said with apartments nowadays. Yeah.
Yeah, I think the trend is definitely going to continue. Is there like one reason why you didn't invest in that fund? Was the return just wasn't there, or what
I
were your
think what it
thoughts?
was, yeah, I think for me, anything I go into immediately, I'm looking for cash flow to begin within 60 days or less. And I think the
Okay.
way that fund is it's going to be like 1 or 2 years of development, and then we have to stabilize, and then we're going to cash flow. And I'm not a big crystal ball guy. What's the world look like in 5 years? What are rents? I have no idea. And so I just had a hard time with those assumptions.
Yeah. Yeah, that makes sense.
So we were talking in the green room about you guys being asset class agnostic. All right. I'm asset class agnostic with our company. I just want to hear about why you are.
Yeah, just to clarify for your listeners, I personally am asset class agnostic. Ashcroft Capital is only focused on Class B garden style value add, multifamily. So they've never done development, opportunistic stuff like that. So for me, it's as simple as, I started running this math in 2015, and I'm like, hey, back then, what's a conservative annualized cash flow yield that I might expect from these investments if I diversify across a bunch of stuff? I came up with 8%. Okay. Since then, it's been compressed a little, but it was 8%. So I've always managed to maintain about an 8% yield year over year. So when there's equity on a sale, that's just kind of icing on the cake. I can pay my taxes, I can fund some other ventures, or I can roll it into more investments and grow my cash flow, So the point is, multifamily back then was cash flowing 8-9% year one. Today it's probably more like 4 to 6% or something like that. So if I do a multifamily deal with a lower cash flow, then I in turn will diversify and do something with a double-digit cash flow so that I can average those and maintain that 8% allocation. But it's like, hey, if let's just use a hypothetical here. If the U.S. Treasury bonds are yielding 10% annualized, guess what I'm going to start investing in? Why take the additional risk if you're just going to hold till maturity? And that's the scenario. And that was, this type of stuff happened in America. This was in the 80s. The bank's paying you 10% on a high yield savings account, stuff like that. So I would love for some of that to happen. And I'm not going to chase an asset class off a cliff if in the future multifamily is giving you 1 and 2% yield, but money market's giving you 6%. I'm just going to be a money market guy.
Yeah.
So
For
do
sure.
you search for market inefficiencies in your in your asset class agnostic strategy then?
Yeah, because what's interesting is, I use that example of 2015, and actually it was a few years prior that I really started kind of doing a little bit of research. But, the cap rates and the cash flow were drastically different back then. Let's call it 2012 to 2014 between self-storage, mobile home parks, and multifamily. Drastically different. Mobile home parks probably having the highest cash flow potential. So institutions came in and started buying everything up, especially in funds and pools and masses. So all of it got compressed to be almost equal today. It's very, very comparable within a couple percentage points. So yeah, you always have to be looking at those opportunities. And I always say, I used to work for one of the biggest brokerage firms in America. And I did that for the education, not, to be a stock guy, but just to be a little more unbiased. And the conclusion I walked away with is, the stock market being publicly traded has extreme overvaluations and extreme undervaluations. And, in 21, we saw that some of these stocks trading at, 100 PE ratios and just nonsense numbers. And now today we're seeing the exact opposite. We're seeing big name companies that have fallen 70%, 80%, year over year. So, anything I do in the stock market is going to have a cash flow component. It's going to either be a dividend paying company or a REIT, a real estate investment trust. And when these get beat down bad enough and the yield goes from 3% at the market high to like 9% today, those become more attractive. So I start looking at stuff like that, to your point. Absolutely.
Yeah.
I'm kind of in the same boat. I think that the reason why I have been attracted to real estate as a majority of my asset allocation is because real estate markets are very, very market inefficient, right? You don't have all these like quants that are sitting at a trading desk that are creating, efficiencies in the market when there's, maybe short-term inefficiencies that, exist for maybe even a few seconds or even a few days. But real estate, has that lagging factor in terms of where you can find market inefficiencies that exist to capture higher yields in different asset classes. So for instance, I was a, evangelical multifamily investor as a primary operator. And then multifamily just got overheated. So then I found an inefficiency in mixed use buildings because mixed use buildings, retail investors didn't want to buy them because they had residential. Residential investors didn't want to buy them because they had retail. So I was able to find some good yield in there. And then that existed for a little bit. And then that yield got chased out, and there was efficiency and price discovery found that market. So then I moved in post-COVID to office. People thought I was crazy into office space, but I found that there was a lot of deals that were, the investor community redlined them out just because they were office, but we're able to scoop up some deals that were occupied by really strong tenant bases, like government agencies on super long-term leases that are very, very sticky. So we're able to capture some pretty great deals there as well. So
those are great points. And everything in the multifamily space that at least I've been investing in, and I can speak for Ashcroft also this year, been about a 25% discount, roughly speaking. And what I'm comparing that to is previous pricing of like 21 and early 22. So I've heard, and I don't do much in office, but I've heard, that's the leader right now and kind of the bad news. So I wouldn't be surprised to see steeper discounts there. But we got to remember that in commercial real estate, it is so driven off of the capital markets, off of what the Fed does and where interest rates are and things like that. So if you're able to buy this dip, no matter what class we're talking about, and then the Fed ends up tapering rates down in 2 to 5 years, in theory, we're all going to do better on these deals than we ever did in the past when interest rates were 3 and 4% up and down constantly. We were kind of buying and selling in the same type of capital market, right? So I think it's a great time. I think it's a much healthier market now in commercial than it was over the last 2 years. I was getting skeptical in 21 as well, overheated on what wasn't overheated,
right.
And to your point, people who are thinking, hey, I can go get a CD at the bank at 5.5% today. Well, that's true. But what about in 2 years, right? That may not be a sustainable strategy. If rates come down, so do those. And so you have to renew it like 2% or something. We'll see.
Right. Yeah. Yeah. Well, maybe we should shift the conversation over to thought leadership. I know that's a big proponent of what you do with education. Yeah. Are you finding yourself just kind of doing that pro bono a lot, or are you trying to take what you're doing and then at least utilize it through your different channels to monetize it in some way, or not?
Yeah,
really?
Mark, good question. So I monetize nothing. I have no courses, books, or anything at this time. I may end up doing a book, and that's not going to be for profit. I'm probably end up either donating that or whatever. But my pro bono has been under Joe Fairless's Best Ever brand. I wanted to step up and be a host of that show. We have 3 hosts right now. He's kind of, it used to be Joe himself and 1 guest a day, and it's a 365-day podcast. It's the longest daily running real estate podcast in the world still. Well, that gets to be a lot when you're a general partner and a marketer and a IR guy and all these things. So I came on board to kind of lift some of that weight off his shoulders in 2019. Started with, the Best Ever podcast segments and passive investor tips I run once a week. And then I do a lot of content for Ashcroft Capital. And as I mentioned, I'm a guest on a lot of shows. I do a lot of webinars. I do a lot of conferences and stuff like that. But really, that's the fundamental thing for me is that when's the last time you were driving down the highway and you saw a billboard for syndication, right? Or promoting passive income, not interest from the bank, but real passive income. So you don't see these things. They're not mass marketed. And I mean, I'm shocked every year at the amount of accredited investors I speak to that have no idea what a real estate private placement is. No idea, and these are the only people in a lot of cases that can even participate in them. So my goal is just to get the message out and say, look, I do it full time. I've done it for this long. And I got people in my network that have done it 3 times longer than me. It's a real thing. And I'm happy to sit down and share that with you. And it's not all pros. I mean, there's risks with anything. So we got to be fair on the pros and the cons. But to me, it was such a game changer being able to be a hands-off investor. It lit my world up in so many positive ways, allowed me to meet my wife and for us to have our son now. And it's just been a beautiful thing.
Nice. Do you have plans in the future to try to monetize all these efforts? You're building this great brand, this great track record. Is there an end goal?
For me, there's not. and that's been fully intentional. It's not like I hadn't thought of that. I recognize we live in a capitalistic society, but are you guys familiar with the FIRE movement?
Yes.
So for those listening that may not be, it's financial independence, retire early. There's a lot of things I like about this movement. There's some I don't. And the one that I don't is that the only real investment that most of these people are making are purchases into an index fund in the stock market. And that's it. It's just put your money there, wait till you retire and start withdrawing or whatever. So I chose passive income investments. That's the biggest change to that methodology. But the key components are, if you're younger and you can go hustle and you can go make money like I did in oil and gas and flipping properties and whatever, and you can be frugal for a period of time, I'm not saying forever, but live below your means pretty significantly for a while, then you can have what most people will never get, and to me, that's time freedom. And so it buys me time. That's why I invest for passive income. And that's what's allowed us to travel. And I'm circling back to your question here. Why is there not a big exit master plan, or why am I not building up this huge thing? Because I've sat down with my wife many times and we've looked at how much is enough. And we are not very needy people. We are very humble people. We live a very humble lifestyle. And we have what we need and then some excess, but we always want to maintain that buffer. So, I'm here doing this as long as it's applicable and I'm adding value to people. And at that point, we'll change the game up. We'll do something different. So
that's incredible.
Yeah, the real estate FIRE is kind of the thing that I'm evangelical about. Because I've heard of the FIRE movement through S&P 500 indexes, and stock market has its pluses in terms of being liquid. I have to have a certain amount of liquidity on my balance sheet to do the deals that we do. But I think that it's difficult to from a marketing perspective. I just went to the Bigger Pockets conference a few weeks ago, and there was all these people around with wearing T-shirts that said sub 2 on it, right? Talking about the sub 2 Pace Morby program and that sort of thing. I didn't see anybody walking around that said they had T-shirts that said private placement on them or anything like that. So it's kind of like that, that sort of like bumper sticker to white paper, kind of like cultural and marketing shift. I think that us as an industry need to do a better job as not making it, because a lot of us are hesitant to try to make it sexy or make it the new hotness. But getting people to think about it differently and making it, more, there more democratization around being able to have access to real estate without having to, be in the trenches and dealing with the tenants' trash toilets and all the time that is involved with it.
Yeah, from everything you see in most programs, most seminars, most marketing, it's the low-hanging fruit. It's the simple, low barrier of entry, no skills required, $100 gets you through the door, that kind of stuff. And this is why everyone wants to be a stock trader and be a YouTube influencer and be a drop shipper and be a crypto collector. It's this idea. It's like the lottery mentality. The reality is very few people really make it doing any of those things if you look at 10 and 20-year horizons. But it's very enticing to think about, right? Like, what if you did win the lottery though, right? It's worth a shot. So I always say, what I do is boring but effective. It's kind of the same thing over and over. It's pretty simple to understand, but housing is housing, man. Multifamily housing's been around for like over 2,000 years at least, probably longer, but as long as people lived somewhere, not everyone was a homeowner, So, yeah, it's a viable business that makes it through volatility and downturns, but of course, again, not without risk.
Am I frozen on your guys' screen?
Yeah, you're a little bit frozen. So I'm trying to read. I always try to, it's a 2-on-1 interview type of thing here. And I always look at Mark's face on there to see like, okay, is Mark going to ask a question or should I jump in? So we're still trying to get the hang of it. So Mark,
he's writing down some good notes and has been for a minute now.
Yeah. Well, I was thinking that maybe I should restart and you guys can just go on for a sec. That way I'm back online. I can't see you guys either. My stuff is totally froze, but at least you can hear me. So
yeah, no worries, man.
Right, I'll be back in a sec.
So, all right, we'll wait for you. So Travis, from a marketing perspective, like, what is your like marketing plan and what does it look like in terms of like the marketing strategy and then also the tactical things that you have built in, because you have a whole suite on the thought leadership platform. So kind of like, can you tell us a little bit about those, like, the overall strategy and tactical type of components to what you do with your platform and also Ashcroft?
Yeah, sure. I mean, so there's two ways to look at that. There's kind of what does Ashcroft do as a multifamily syndicator, trying to get the word out about their deals and all that. And then there's what do I do? I'll start there. What I do is I just assist everybody in their pre-existing thought leadership platforms. So I mentioned, taking over some episodes on the Best Ever podcast that I do on a weekly basis. I might, write content for them, write a book for them, whatever. I think that the platform in general is critically important. And then I do a lot. I've got my own YouTube channel. I've got my own personal, Insta and LinkedIn and stuff. So I'm out there taking snippets and parts of what I do and just pushing it out. Nothing paid, no paid ads or anything, because I'm not selling anything. I'm just out there trying to get the information out. And then Ashcroft's more traditional as a company. I mean, they're running their ads through the different platforms, and they're working with marketing consultants and they've got in-house marketing staff. And so they're trying a lot of things as well.
Yeah. Speaking of like paid ads, and I know you don't run any paid ads personally, but that's the one thing is it is kind of frustrating. And the reason why I love podcasts is because it's one of the only long form content stuff that's actually like not dead. The social media platforms tend to like prioritize, short form content, like 60 seconds or less in terms of video, or 15 seconds even in some cases. So it's been really frustrating for me. And so, my strategy is I try to create short form content that will funnel people into long form, like my podcast, for instance. And been experimenting around that, because that's ultimately where I'm trying to get people to land, is that like you can't learn a lot through watching 15-second videos. Like you got to kind of like dig in deeper than that. But there's a whole thing like attention is the new currency, which is like frustrating for me, but I'm also like fascinated by it to try to figure that out and be more of an effective educator and marketer in the space.
Yeah, I followed that same pattern. For example, I love to read, and historically I've read a lot of books, but what I don't like to do is pick up a 500-page book and read it. It's overwhelming. I just don't see the end in sight. I can't wrap my head around how long it's going to take. If it takes months, I might lose interest partway through. So everything I've done through my podcast is simplifying to 5 to 7 minute episodes, right to the point, no fluff, just like, here's what it is, why it's important, how you utilize it, and reach out if you have any questions. That's about as short as I can consolidate most points down to. And I can never meet those metrics of like 30 to 60 seconds. To your point, it's not, to me, it doesn't feel like enough value can be put into that kind of time frame, even though people want to see it. Everyone wants the short answer, right? What's the
Oh, yeah.
miracle pill to lose the weight? Boom, it's this one, right? What stock do I pick? That one. But it just doesn't work that way, man. You need more fundamentals, and you really got to take the time. And unfortunately, I think that's what a lot of people miss is taking the time to build the formal foundation for what you're doing. If you're going to be professional, or if you're going to be long-term successful, right? It's always a 50-50 coin toss on, picking random opportunities. Half are going to win, half are going to lose, but it's all about odds. It's like the game of golf. Most of us can attempt to play golf, and throughout 18 holes, you're probably going to have a few really good shots, but you're probably going to have a lot of really crappy shots. And so the only thing that turns somebody pro is the consistency to have more great shots and far less crappy shots so that you can win the game.
100%.
Yeah. Thanks for having me back, guys.
Sorry.
Thanks. So what were you talking about? Like long form versus short form?
Yeah, long form versus short form content, just kind of like the strategy around the thought leadership platform. Because I just can't bring it like in me to just like, all right, what type of clickbait can I generate today to to get somebody to watch this thing, this entire 15-second thing, because I just don't get the context out of it. Because ultimately, at the end of the day, I'm trying to educate people, either educate, entertain, or inspire them, or like a combination of all three of those things. And so, and ultimately, I'm trying to use that as a funnel into like the more long form stuff, whether it's something that's on my podcast, your show here, Mark, or one of my colleagues, stuff that I figure, because I point people to the best ever show all the time, because it's the first time where, actually, funny story, backing up a little bit, Joe Fairless had a mentorship program for a little bit of time, and I got on a strategy call with him, and I completely blew it. So he had some homework to get prepared for the strategy call. I just didn't even look at the email. I jumped on a call with him, and he's like, "Yeah, so how'd you do in your homework?" And I was like, "Wait, what homework?" And he's like, "All right, well, people that I typically work with, I want them to be wanting to do this, not just get on a call with me and that sort of thing." So he gave me a lot of great advice in terms of, and this was back years ago. And around the time when he was Reed Goosens, for instance, was another great operator that they listened to. But Joe definitely, told me, he's like, you need a platform, and, you need to put, just deposit positive stuff out there into the universe with no expectation in return. And that's what thought leadership is about. It's not about calls to action, all the time or anything like that. You're just trying to create value out there for people, and hopefully people will think of you as a subject matter expert on a certain thing.
100%, man. That's truly where the value is no expectation in return, which is every single one of my podcasts. There's never a call to action, other than if you want to reach out because you got questions or want to connect, I'm happy to do it. But other than that, there just isn't. Yeah.
There's no way to add much value in 20 seconds. The only thing you can do is try to hook somebody. And if that's your whole mentality, then you're not really working on education. You're just working on hooks all the time. So I feel
I think there's certain services and products that would work exceptionally well for. I always joke because trying to find accredited investors and get in front of the right people is extremely hard. And it's a very low percentage of the overall population, as you guys know. And so I always joke, I should launch a taco business, and I ship the tacos right to your house, right? And I got a promo for you, right? And you better act now because it's limited supply. And I'm just thinking through the marketing. I'm like, dude, I could crush Instagram with this. Anyway.
Yeah, we had a speaker come on yesterday in the mastermind that I'm in, and he's doing really, really good on Instagram. He's just doing it himself. He's his own copywriter, and really his big thing was I'm just trying to tell them that I'm going to add the value in that 20 seconds. So knowing his avatar, knowing what they're looking for, and then telling them, hey, I've got a solution for what you're looking for. And that's been working really well to not only drive people to his funnel. I think he's received 50,000 people that have come through the funnel and actually entered their information and gone to his website. And his whole platform is based on, it's like a franchise. And so, they're using the land and they're using the farm to leverage building a house. And his company is he calls it Axe, and it's kind of all inclusive. So, you can hire a ranch hand if you don't want to be the person doing all the ranching. They're going to take all your products from you and sell them for you as a collective. So, you don't even have to worry about how am I going to sell these eggs or how am I going to sell this milk. It's all kind of put together in his Axe package. I just thought it was really clever. And, he's going after something that people want, and he's become very successful at doing it. So it's just kind of cool to say, okay, I understand how that works organically. And it was good to see a good testimonial of somebody that's actually done it and been successful.
Yeah, I appreciate you sharing that because, in the past, so I only really started on social when the onset of the pandemic happened, because leading up to that, I was doing all face-to-face, all in-person stuff. And all of a sudden our world turned upside down. Conferences are canceled. You can't meet face-to-face. So I didn't know what else to do. So I turned to LinkedIn and Bigger Pockets and, Facebook and Insta, and YouTube. But I'm not the expert in it. I've probably only put a couple hundred posts out there, and I've got some followers and stuff. But just to know that strategies can really work in your favor. That's interesting. I might want to get some more details on that.
Yeah, it was relieving because his perspective was pretty much because in the masterclass they're teaching us all these things that we got to do. You got to do this, you got to do that. He's like, I didn't really do any of that. He's like, I knew what I wanted to do. I knew what my vision was, my values. Yep. And I just put that out there, and it organically just caught on fire. And so when he said that, I was like, okay, maybe I'm thinking too much into all this stuff, and I need to get back to, my roots, my passion. What is it that I really want to be focused on, instead of getting into these nitty gritty details of how to, make yourself more searchable or whatever, prominent on these platforms.
It's always changing, like we talked about, just like markets and cash flow and yield. I mean, the landscape's always changing with TikTok and what was that, Lunch Club, and I don't know, all these different platforms coming out. So you really got to keep up with it. I just try to make one piece of content, chop it up, and put it in a lot of places, and then see what sticks, and then double down on the best working, platform.
It's like another job, though. You do it and you're like, how much time am I spending doing all this stuff?
I know it.
Crazy.
I know it. That's true.
So on that franchise that you're talking about there, that's almost like he's combined lifestyle brand with real estate, which I think is actually pretty cool.
Yeah.
Because there's one thing is I listened to the Economist podcast and Financial Times podcast. And there's one thing that there's country music, for instance, is at an all-time popular high throughout the world. Right, wow. Brazil being one of the highest consumers of country music, because there's this lifestyle thing of getting back to the land and getting back to nature and all this stuff. So being able to fuse the both of those is actually a pretty cool idea. I'm trying to get the wheels turning. Is all right, how can I do a lifestyle brand over what I do? I'm kind of I think it's going to be hard to come up with an idea.
Yeah. I was scratching my head for sure.
Yeah,
I wanted to buy a franchise at the end of it.
In recent years, what I've seen and again, it's a shift in trend. If you think about production and technology of cameras and lighting and all this stuff, there was a time where people almost went to the farthest extreme of over polishing content. It was perfect. It was, everyone's in their makeup and everything's, top notch. But then it kind of turned in the recent years into just pull out your iPhone and talk to people with your t-shirt and just say what you want to say. And people resonate way more with that right now. But that's a phase and a trend. We could very well go back the other direction in 20 years. So you just got to go with what's hot, I guess, what's working.
Yeah. And even these YouTubers that were just pulling out their iPhones, now they've gotten more polished and they're starting to look more like production studios. I mean, just look at Mr. Beast, for example, and how much money he puts into his videos. So, that just started as somebody with a camcorder, and now look where it's gone. So I agree. I think there's a lot of trends that are going to unfold as we move forward.
Yep.
So Travis, in terms of what you're seeing out there in the market, we talked about market inefficiencies earlier. I know we talked a little bit about fixed income being some market inefficiencies there. What do you see out in the real estate market where there's some possible inefficiencies that exist in the marketplace?
Yeah. I mean, if you think about a market cycle from, phase one, accumulation, phase two, the uptrend, phase three, the top of the market, phase four, the downtrend or the recession, and then kind of the bottoming out and then circling back. I think we're somewhere in the beginning stages of 4. We're seeing a lot of downtrend, both in stock market, commercial real estate. A lot of things are down. If you remove the magnificent 7 out of the S&P that prop it up, I mean, the market's down. That's what people got to realize. And I'm an individual holder of many different, one-off things, not significant holdings of mine, but most of those are down, 30, 40%, whatever. So there's that. In the commercial space, what I think is we've got a lot of commercial debt coming due from these floating rate loans that were initiated a couple years ago from 21 to early 22. And we've already started to see foreclosures and, a lot of people who over leveraged or didn't buy interest rate caps or didn't go fixed rate having problems. And I think that's only going to continue unless something's done by the Fed or the government or stimulus or something. So I wouldn't be surprised in Q1 to Q2 next year, and pending recession or not, and pending again the Fed, that we continue seeing that. I think we'll see the most next year, early next year of that. But, it's not, there's a lot of people on the sidelines, especially institutions right now, with just absorbent amounts of cash waiting to pounce on these. So it's not like it's going to be all this stuff sitting on, the market for sale. It's going to get caught up so fast that if you're not paying attention, you lost out, So I think it's a very short window, relatively speaking, that we see this kind of discounting. And once rates, start to come down at some point, because we hit the Fed's inflation target, we go into a deep recession, the national debt gets out of control and they got to cut rates, whatever happens, it's likely to happen, based on the forward-looking forecast. So I think the saying is still true, like survive till 25.
Do you think that includes single family in there too? Or do you think single family is kind of in a realm of its own, and because we're so undersupplied and it's going to be relatively unscathed?
So here's an interesting parallel for your listeners. So 2008 was mostly a single family home crisis. And for the same reasons that we're seeing some commercial real estate in trouble right now, it's almost the exact parallel. It was people who took out a 3% loan, made their payments just fine, but all of a sudden it's a 6% loan and you can't afford it. Same thing. But see, with single family, you've got the benefit of going with a 30-year fixed or a 15 fixed. Those are the two most common types. And most people aren't doing adjustable arms and things like that in recent years. So if you've got long-term fixed rate debt, and I think it's something like 70% or higher of the single family home market has either bought or refinanced somewhere around 3%, maybe 3.5%, somewhere in that ballpark. Very few people are buying right now at 8% mortgage rates. So that's not really going to cause a massive crisis. The crisis is people don't want to sell their homes right now, because if you're going to buy into the same market, then you're trading up that rate 3% up to 8%, and home prices haven't really come down to justify that. So you're kind of screwing yourself, right? So I think what happens with single family is if and when the Fed cuts rates, let's say they cut them in half, all of a sudden, all this inventory starts to flood the market with single family, which creates a lot more competition and options for buyers, which means potentially price cuts at that point. The only reason they haven't been cut that much is because there's very little supply on the market. So I don't see it as like a 2008 in any regard. I mean, lending practices are 100% different. Everyone buying today is highly qualified. Lenders are very skeptical, cautious, and conservative. So it's just different. It's like they say, history doesn't repeat itself, but it rhymes.
So maybe the play is, if you're, just starting out, you sell whatever you've got now and you just kind of wait and rent for a couple of years.
If you're looking to become a home buyer, my personal thought, I'd be a renter, man. We got $1,000 a month gap right now. And rents don't go up, they're not projected to go up like they did in the last 2 years. We're kind of at a plateau a little bit. So I'd be a renter until rates change or pricing changes. That's my personal opinion, but we were one of the people that bought with the low rate. So I guess I'm stuck.
Yeah, the golden handcuffs, as they say. Kind of an interesting story. And I have a 4.5% interest rate on our house.
Okay.
And I remember when interest rates were 2%, my friends were like, "Oh, you got to refinance and get in a lower rate." And I'm like, and I was like so jealous, right? And now I have friends that are like, buying stuff at like 8% interest rates, and now I feel like, all right, well, like I feel a little bit better now.
Yeah.
But yeah, a little bit of the story. I go to regular real estate conferences. There was a conference I used to go to called Tri-Guild, which is like a distressed debt investing conference. And back several years ago, there was all of these loan maturities coming due on commercial mortgage-backed securities and multifamily and that sort of thing. And everybody thought it was going to be like the next shoe to drop in terms of commercial real estate. It didn't happen because prices kept going up. And it was funny to see at this conference in San Diego that there were no special services there. And there was a ton of attorneys that were there, right? Because the attorneys that had partnership with special servicers were out there like starving, looking for business. And there was no special servicers in sight, when typically there would be more there. So I'm curious to see at the next conference I might be going to in Dallas, for instance, in 2024, how that shift might happen in terms of there being, more special servicers going to that conference than the other time I went there.
Yeah, I think that's a great point. A great story. I don't know. There's been a little bit of talk recently about reverse market crash. Have you guys tuned into any of this?
No, tell us.
It's kind of an interesting concept, but it's basically where the economy is really not doing well. And, by and large, we kind of feel like we're in the midst of a recession, but prices are going higher. And the reason is, if you think, let's say tomorrow, for example, the Fed cut interest rates in half for whatever reason. Okay, half. So everyone thinks that's a great thing, but the poor would actually get hurt by that because the poor aren't owning, for the most part, real estate, assets, stocks, et cetera, right? So all that means for them is rent starts to drastically go up again and consumer products keep going up with inflation. It just hurts them. That's it. The middle class is divided in this instance because those who are maybe middle class based on their income and job, but say they're younger and they're looking to become homeowners or something, and they don't have a lot in the stock market, that only hurts them because if they can't buy a $600,000 house today with an 8% mortgage and the Fed drops rates in half, that home maybe turns into a $750,000 home in a year or two with a 4% interest rate. So that doesn't really help them either, and their portfolio doesn't go up with the stocks. The other side of the middle class is going to be the older folks or middle to older that have home equity and have portfolios of stocks. Of course, it's going to benefit them. But who does it really benefit in that instance? The wealthy, the rich, and investors, right? That's the category, right? And so you have to be investing to benefit, right? And I've always been a dollar cost average guy. I knew I was overpaying from time to time, but I just keep buying in at regular intervals year over year. And I don't want to sit on the sidelines and miss this because what if today in the next 3 months is the dip? And that is it. It's kind of like where the stock market came down in 2020 in March, like 30%, like instantly, right? Well, then what happened? It went all the way back to all-time highs in less than a year. So, and I was that person at that moment looking at stocks going, I see like a 50-60% decline happening here. I don't know about this. And then I missed the whole thing. So I'm not playing that game.
Yeah. How much floating rate debt do you think is out there and other, debt with like the no cap on the interest rate? Is there a lot, do you think? Or?
Well, I don't know about with no cap, but what I can say is from 2013 to 2021, it exploded like you wouldn't believe with adjustable debt because interest rates had just been low. And every time the Fed would say, yeah, we're going to raise rates and they'd start doing it, they'd taper back down to zero or whatever. We had the pandemic. And so people got used to not believing the Fed or thinking, yeah, they say they're going to raise, but if they do, it's only going to be a couple points. We'll be okay. And I went back the other day and I looked at the FOMC minutes and the forecast of December and of 2021. And this is what everyone had to go by for data. If you're going to buy real estate, what do you do as far as your debt? They showed on this graph 2 to 2.5% Fed funds rate moving forward for the foreseeable future. Well, we're at what, 5.5? So they went twice as hard as what the projections were. So I can't put a lot of fault on people that were using adjustable rate, but I never did any adjustable rate deals unless they had a rate cap. But even at that, they're struggling right now because you got to rebuy a rate cap. It's like an insurance policy for a couple of years. Once it expires, you don't have the cap. So you need it again. Well, a lot of those prices went from 100 grand in 21 to $1 million today. And that might be per property. So you got a syndicator out there with 20 deals. That's $20 million that they got to come up with right now. And that's what the crisis is. It's a capital market crisis. It's not about the fundamentals. It's not about occupancy, collections, rents, people staying people need places to live that are affordable. So there's no issue there. It's all about interest rates.
Yeah. What kind of price decline are you expecting over the next year? On the
I hope
multifamily
in the
B-class?
multifamily space, we don't see much more than we're seeing now. The Fed has now not raised rates twice in a row. I don't know if that indicates that's the top. I don't know if they end up going another 25 basis points. I don't know, but I would say if they stay here, then the declines will be relatively the same to what we see right now. If they keep raising, of course, we'll have steeper declines and more people that can't make ends meet. So I don't know, man. I don't have a crystal ball, but every deal I'm doing is fixed rate debt for at least 5 years, and hopefully has some lower prepayment options with it so that you're not subject to hold it, the whole 5 years or something like that. So just kind of, again, survive till 25, right?
Why not go with like agency debt over like a 5-year term? I'm relatively new in the space, so I always wonder, like, why wouldn't somebody just go with agency versus 5-year?
Yeah, well, I mean, and I'm including agency in that. So you can do, 5-year terms. Some of that's interest only, some might amortize. It all depends. There's so many options out there. But I've seen from an LP perspective, lenders getting a little more flexible on their terms, especially when it comes to like prepayment, because everyone's thinking the same thing. I don't want to lock in long-term at potentially the highest rates possible and be stuck in the other direction, right?
Yeah.
So they're trying to get a little more flexible with that. I think it was Fannie Mae just rolled out a 5% down for small multifamily or something. I haven't read completely into it, but there's things that are opening up to try to keep the market flowing.
Is there just too much penalty on something like, a 30-year term or 25-year term?
Well, it's just not common in commercial to do 30, and plus a lot of syndicators are using a 3 to 5 year underwriting model. They hope to buy it, value add, bump rents, and sell it. So 30 years. I mean, there are operators that'll hold indefinitely, but usually it's pros and cons, right? Like you could subscribe to either model. In my personal experience, I've done both. I find 3 to 5 years, at least historically, has worked the best. It's had the highest overall annualized returns year over year, because in the deals that I got in, a couple in like 2015, 16, right? Multifamily value add, they've never sold. So what's happened? Well, we started with like an 8% cash flow year one, and then it went to 9, and then it went to 10, and then it went to 11. Then the loan started to amortize. So our cash flow dropped back down to about 8, which is like right where we started again. Then we have to start saving for CapEx reserves, because this property is only getting older. It's going to need a new roof. It's going to need new HVAC. It's going to need new. So you got to hold back some of that cash flow also for those reasons. So it kind of feels like sometimes we're going nowhere. You build up and fall back down and build up and fall back down. And it's just kind of a lower cash flow play. And hopefully equity's there in a very meaningful way one day, but we're not there yet. So
gotcha.
To be seen.
All right. Well, looks like we're at the top of the hour, gents.
Nice.
Wow, that went super fast.
Right?
I really
Travis,
did.
you want to let everybody know how to get a hold of you?
Sure. So Instagram and Facebook, you can search at Passive Investor Tips. You can find me on bestevercre.com. If you want to hop on my calendar, you can go ashcroftcapital.com/Travis, and I'll make myself available for you. I do 15-minute calls with people, no upsell, no obligation, all day, every day. If you have any questions on anything I covered or didn't cover.
That's incredible. So what a way to pay it forward. Well, thanks everybody for tuning in to this week's episode of the Misfits of Real Estate. We will see you next Thursday at 2:00.
Thanks, Mark. Thanks, Matt. Thanks, everybody.